A very good afternoon on behalf of India FinTech Forum. I am Aditya Rajkothari and I have Mr. Raman Kumar, founder and chairman of CASHe, who has joined me to discuss about the lending industry and his entrepreneurial journey. Raman Kumar is a successful serial tech entrepreneur and a private equity investor. He is the founder and former chairman CEO of Nasdaq listed M Model Incorporation, a leading voice recognition healthcare document technology company that he took from a startup to until it was sold to one equity partner for $1 billion in 2012. A very warm welcome to FinTech Leadership Series.
Thank you, Aditya. Thank you so much.
Coming to my first question, CASHe is India's first mobile app based that gives salaried individuals immediate cash by using their proprietary technology called social loan quotient. Until now, CASHe has disbursed loans worth 4,000 crores and have 75% repeated customers with over 20 million app downloads. In addition to this, recently in the Series B round, CASHe got an investment of around $19 million from TSLC. What has led to this success? What inspired you to start CASHe?
Great, Aditya. So let's go back to the genesis of the idea of CASHe. Way back in 2015-16, I was in a conference in San Francisco, and I had at that particular point heard for the first time a company called Sophie in the US. And Sophie right now is a public listed company. And in 2015, when I had met them in a conference where I was also one of the delegates, Sophie had just been invested in by SoftBank at a 5 billion valuation. And they had started the company on the premise that there are students in the Ivy League in the top 10 percentile, who actually had the same interest rates as everybody else. And they wanted to figure out a way to reduce the school loan, the college loan interest rates by about 50 basis points to 100 basis points. And that's the genesis of how Sophie started its business. So that was the spark, really, in terms of saying, okay, there are a bunch of millennials, they're outside the credit system in India. And is there a way to address that entire demand, which is unaddressed? I did not want to look at student loans because it's a far more complex territory in India. So the reason was basically to look at a cohort which is fairly uniform. So we looked at the millennials, we looked at the salaried millennials, and we then did a research on, what's the credit card penetration, what's the debit card penetration, smartphone penetration, and then taking the view on the entire gamut of data that we could collect. We said, well, this is something that we could address, but however, the cost of administration, the cost of lending small amounts to this cohort is prohibitive, which is what the conventional banks and conventional institutions never managed to successfully steer through. So the idea was then, how do we go and solve the problem? And that came from creating an algorithm. So I then, reached out to my data scientists. Since I came from a voice recognition system with natural language processing background, the idea of this business wouldn't have come about if I didn't get that algorithm. So the first algorithm that we created, of which I'm one of the co-inventors along with the data scientists, is called SBF, which is a social behavior filter, which we started sometime in the beginning of 2016. By the time it came to a level where we could start experimenting with it, it was middle of 2016. And that's when we started to give small loans, 5,000, 10,000 for 15 days and 30 days, only to collect data as to if we give a loan, how does the borrower behave, and what kind of background data, what do we require? And that's really how the CASHe app was launched on an experimental basis. And in 2017, we started, we bought over an NBFC, and that's when the commercial launch of the whole platform started. So that's the background. So the idea was to go change the world of millennials and Gen Z in a manner which has not been addressed hitherto. And if you could expand the credit system by using technology and also making sure that a larger pie was created within the credit system, that was the motive behind starting CASHe.
That's really interesting. Fintechs operating in the digital lending space are claiming that they are making the customer journey seamless and offering the best credit experience. What are the data privacy challenges that CASHe faces in making the process seamless?
So Aditya, now the business since 2016, when we were one of the pioneers, to now, it's a very mature business where a lot of players, even digital banking with banks trying to do neo banking, processes that they have put in place. But however, the way in which this system works is fairly antiquated even now. The systems which govern banks, their own processes are still fairly tight and kludgy. They don't, want to take risk on anything or anyone who fall below a 700 bureau score. It's a very tough ask for banks to prove that. So that's where they have this whole first loss kind of a deal with a whole bunch of fintechs, where their losses are actually parked with the fintechs, and they basically only want to do the lending piece without taking the risk on the customer. Now, that is a model that cannot be scaled up to a level where, unless banks start really looking into these customers as their own, there's always going to be a friction between the fintechs and the banks. So obviously, then NBFCs stepped in. There are a bunch of, and the only way fintechs like us could lend on our own balance sheet was to buy out or establish our own NBFC, and that's really how we actually lend money on our own balance sheet. Now, the data process of collecting is based on unconventional methods compared to the conventional methods of banks, where we have the app, which is the primary source because we are digital and we don't exist anywhere other than on an app. We have no branches, we have no DSAs, since there's nobody collecting any information. The second portion is obviously the social media, which is where people can download the app and get into the app, which is through LinkedIn, which is through Google, which is through Facebook. So that's the social media aspect of the business. And the third one is obviously, the metadata, which is on the phone, the smartphone, in terms of the smartphone habits, what kind of apps you have, what kind of usage that you have on the telephone, and as well as the other metadata that we are allowed as per the norms of, let's say, the Google Play, which is for Android platforms, and for iOS, whatever iOS allows us as metadata. So these three form the crux of picking up information on the customers. Now, obviously, at a 20 million people who have now downloaded the app, our data content is very rich. So we can actually now predict with a simple name, we can predict fairly accurately what would be your salary, what would be your score. All that can be done in a fairly predictable and easy manner because we actually now are 5 years old, as well as we got very rich data within the system. So somebody starting now, it's going to be a long haul, but someone who's been around for 5 years, it's a fairly short haul right now in terms of picking up all the right information and looking at how do we approve and how do we do credit risk analysis.
Yeah. Okay. What changes did you observe in the millennials and the Gen Z post-COVID?
So we do an annual survey, and I'm sure you read the last survey that we did for 2021, which was released in January, February of 2022, where we've seen that the the shift from what I would consider as elective expenditure or something which is non-consequential expenditure to more consequential expenditure, which is primarily deal with wealth, to health, to savings. So there's a whole bunch of things that have started to happen within the cohort. A lot more responsible from the point of view until I guess the time when COVID has receded, and then there is a bit of revenge buying that has kicked in. So there's a lot of revenge purchasing that's happening and revenge spending because people have been dormant for 2 years. So it's expected that the spending hike would happen. But that's something that's happened. But otherwise, we find the cohort to be a lot more responsible than what they used to be way back in 2018 and 19, where everything was about shopping. Everything was about buying fashionable garments.
Yeah.
So, yeah, things have changed.
Yes, indeed. Public sector bank, Bank of Baroda, has recently announced the launch of an end-to-end digital platform to facilitate co-lending of loans in partnership with NBFCs.
Yeah.
The bank is targeting to partner with at least 10 NBFCs and to build 10,000 crore co-lending loan book through the digital platform within the next 2 years. With the entry of public bank in the co-lending industry, how will the fintech companies survive?
So again, as I said, I go back to what I had just explained earlier. Um, as long as the bank's internal systems do not let the approval process happen to new to credit, subprime, near prime, and below prime. You can classify customers in many forms that way. Basically, people who don't have scores of 700 and below, which is a very easy way to address this particular cohort. Now, for this particular cohort, the only method by which banks are approving right now is to have an NBFC that takes the risk on them. And the FLDG, the first loss default guarantee, is provided by the NBFC in a co-lending space. Now, what happens with that is banks would get a 15, 17, 18% of their return, whereas the NBFC, they get about roughly, depending on what they charge. If they're charging 2%, it's 24%. So you take a 18%, and reduce the 24%. You got a 6% margin. Now you work on that 6% margin for getting the customer. You got to acquire the customer. You have to service the customer, and you also have to take the first loss. Now, in unsecured lending, whatever be the methodology, and this is proven with credit cards, which are primarily only to prime customers. With credit cards are given to only customers in the above 700 range. The typical NPA is in the 2.5% per cycle. So typically that can go up to and when I say in the cycle, we're talking about the 120-day cycle or the 90-day cycle, which is established by RBI for any NBFC to be able to provide for losses. And though it is not, beyond 120 days, it's not that you don't get the money, but it's not in that working capital cycle. So that's one of the issues that the NBFCs have to deal with. So that loss will be closer to about 9-10%, which they need to provide for. So the 6% is not going to take them anywhere. So this is going to be a conflict between the technology NBFC providers who do FLDG and co-lending until we come to a point where the banks themselves start taking the risk and use technology on a license basis, which is possibly the only way in which public sector banks to even private banks will need to get into this business, which I think is a long way off because for them to deal with what I call subprime is not their main business. They got a lot of prime business in which they basically make money. These are all the noises that are there in the system, primarily because there is a digitization pressure. They need to do digital and they need to acquire new clients. So I think the paradigm, the models need to change So this FLDG itself is coming under scrutiny by RBI. So RBI would now want, you know, fintechs be without a lending license, not to be allowed to be giving any FLDG. So if that rule kicks in, which is probably going to happen anytime now, that will reduce the total number of players from the fintech side who don't have NBFC license. So that's, I think, is one of the issues that we are dealing with, and we are an NBFC. So for us also, one of the reasons why we haven't done much of co-lending is because of that. You know, I'd rather go and take the pie A to Z rather than, you know, work on 5-6% margin, which then is very high loss making. And then the world has
Yeah.
also changed in funding. You probably have noticed now that you can't get funding for losses. So
Yeah.
companies have to evolve and figure out a better business model than chalking up losses.
Yes. Online businesses, especially those that work with sensitive consumer data, have to achieve several compliance certifications. It can be incredibly difficult to keep a track of data privacy laws to regulations that protect credit data. What challenges you face with the Indian regulation law regarding lending?
Aditya, the most important element that has happened since we started the business is data location. That's a first point where, you know, we all use AWS or Azure, you know, one of the clouds, because nobody really sets up any data centers within their setup. Those days are over. Now, as far as AWS location was concerned, you know, it used to be in Singapore 5 years ago. Now, with all the data co-location norms that the government has mandated, it is now that all the locations are within India. Now, that means the entire ecosystem governing fintech and lending is within India. That's number one. Number two is there are standards that have been put in place. There are audits that we need to comply with. And the third most important thing is, you know, the APIs that we devise for interconnectivity with our partners across, whether we are picking up information on banking data or we pick up information from NSDL, anything to do with client information, etc. You know, those are API'd, and APIs are governed by what's called as the OAuth, which is the standard which is out there. And the second most important thing is cybersecurity, along with, you know, all the audits associated with cybersecurity have to be met by the customers. Now, obviously, there've been you know, some payment companies that have been breached earlier. You know, you've heard of MobiKwik in the past, and, you know, a couple of companies like that. And primarily, what we've done is, one of the reasons why we have kept away from the internet as a web as a choice. We just don't have web as a choice for any of our business, is because we want to isolate everything to a smartphone. A smartphone is a lot more secure, and it's far more individualized, and data is restricted. So anything that furrows into our what you call data centers or our servers, they go through a whole lot of cybersecurity checks, and we don't expose any of that stuff to the open World Wide Web. So that is one of the most important aspects of why we selected to be a pure app-based digital lending, and that's what we consider to be the norm in the future, as to why digital-only app is the way in which most neobanks and smart banks are going to work. This is not going to be anymore even a web play. So we just want to keep away from web completely.
Sure. Okay. According to media reports, the digital lending market is projected to grow from $100 billion in 2019 to well over $350 billion in 2023. In your opinion, what are the factors that led to digital lending boom in India?
Go back to the source, as what I talked about was the latent demand for credit, and the fact that out of the cohort of people that we have, our target population is 113 million millennials. What we consider as the urban cohort. We're not even talking about rural right now. So this particular cohort, if their penetration is less than 10 million from a credit card point of view. So they have debit cards. All of them have got debit cards, but their penetration on credit card is very, very low. So given the fact that between a 10 million to 130 million, the demand is just way too high. And the number of players who need to be in the business is large. So there is room for everybody to grow and credit to be enhanced. So there is a lot of play that can be done by fintech and NBFCs and banks. There's a lot of scope for everybody. And even in a mature market, if you really compare, let's say US, which is a very penetrated market for credit cards and credit as such, even there, you found that, like, whether it's a BNPL, alternate credit cards, the boom has been huge, primarily because even in a fully penetrated market like US, from a banking perspective, there was such a lot of demand for credit that was still untapped because of the bureau reports, because of bureau keeping out people who otherwise would have qualified. You just need to figure out how would you qualify them, and you must have the smarts to be able to do that. And that's the assessment that we do.
That's good. The onset of digitalization and transformation in lending has also led to a spurt in digital lending applications sponsored by the non-financial services entities and non-regulated entities, resulting in unethical business practices, misspelling, cybersecurity, and data privacy concerns. How can customers be aware of such practices and protect themselves?
So this part of growing pains of any business. So you always have fly-by-night operators coming in. You always have sharks coming in and gouging people. And that's typically what happens. And the government wakes up and puts the regulation in place, and which is what really happened, where you had a bunch of Chinese firms, what we consider as blade companies, that came in, hired an NBFC here on a rental basis, and then they basically started to lend at an exorbitant rate, very short term, 1 week, 2 weeks, 1 month. In fact, that's one of the reasons why Google has banned anything below 2 months as part of that process, because the idea was that when you take short term, you do on a daily interest basis with a high what I call startup cost, processing fee, as they call it, PF, and with that they basically recover almost most of their money, and then they start gouging people with very, very high interest rates going up to 300-400%. So obviously now RBI has done a lot of work on it, and so typically for an NBFC like ours, which is governed by RBI, as well as we are a systematically imported NBFC. So there are about 500 of these NBFCs that are governed by RBI from a systematic importance point of view. So we basically get audited on a regular basis. We need to submit reports to RBI. So there is a lot of regulation that has come in. Now, obviously, people have to be wary of fly-by-night, small finance companies that do not have the RBI supervision. I mean, you need to believe the regulator now. So obviously, there are like most other businesses probably have their own regulator. In fintech as well as lending, the only regulator we have is the RBI. So we got to go take the rules very carefully and make sure that we follow the rules. And the clients too should beware that unless one is a systematically important RBI regulated entity, you just don't go take money from any and everybody and give data to any and everybody, which is also very important. So all these are, I guess, things that we continuously try to educate the customers ourselves. We put out videos, we put out Facebook messages. There's a
Yeah.
whole bunch of
Mm.
stuff that we do to educate people. But you know what? There's always scope for fraud in this because people
Mm.
are in dire need of money and they have no way to go pick up the money. So it's ultimately the customer needs to beware. So caveat emptor, the customer beware. That's really is the only solution to this, ultimately.
Yeah. Ultimately. Indeed. CASHe has recently acquired Squirrel to foray into wealth management. It has also collaborated with WebEngage to power its user engagement. Zaggle has collaborated with CASHe to offer customized credit solution to users. With so much of value added to the industry, what does your growth trajectory look like for the upcoming years? Are there any global expansion plans?
So Squirrel is part of our overall strategy, Aditya, to expand ourselves to be a full-blown wellness platform. So our idea is basically to lend, to enable spend. We do insurance, and lastly, we do invest wealth. So save, spend, lend, insure. I guess those are the four mantras of our wellness platform. And so we are constantly looking at avenues to acquire companies within that space. Squirrel was a great fit for us. More important, we don't have that spare money like, some of the other companies that have raised a lot of equity. They've got a lot of equity sitting on their books and they don't know what to do with it. So they keep buying companies. We are very, very systematic about our assessment. Unless it's a fit and unless it actually comes to us at a price point which we think is beneficial to our investors, we wouldn't like to go and just purchase any company, nor expand into a territory which is not in line with our overall business plan. So we have this whole CASHe 3.0 project that we are currently in the process of implementing. And part of that process is these four things that we would like to look at. And so we are in the market. I mean, we would be in the market to look at a good insurtech platform, just like we now picked up a good investment tech platform. But until then, we collaborate with a whole bunch of insurance companies. We basically have a large client base, and our app is very conducive for some of these insurance companies to acquire clients using our platform. And that's really what ICICI Lombard does. That's what Zoppers does. So absolutely. And we would like to look at more of such collaborations. And in fact, if we are able to pick up a platform, which is an aggregator, we'd love to take that platform. But it should be the right price, right time, right price. Yeah, right partners.
That's great to hear about your growth. Yeah. You have a decade of experience in the lending industry. Recently, in 2019, you have been awarded as the Serial Tech Entrepreneur of the Year by Entrepreneur India. What advice would you like to give to the upcoming entrepreneurs?
So, Aditya, I think, decade is a bit too long because we are 2016 vintage. So we are about 6 years down the road. 5 years in the lending space, 6 years in the fintech space, and I believe that one of the cardinal rules of any business is that the sector has to have a very large space to grow. The market has to be large, and that's one of the first things for any good entrepreneur to look at is not to look at small niches, which is also a business for what I consider as the SME kind of a business. But when you look into an entrepreneur who's actually scaled businesses in the past, I've sold a business for $1 billion. I mean, for us, one of the first requirements is this a sizable market? The addressable market should be large enough for us to grow grow to a level which I think is worthwhile and scale. And so that is an important thing that you need to look at. So for a young entrepreneur coming into the business, you have to look at two things. If you're looking into a niche, it has to be so specialized that you must be completely irreplaceable in the scheme of things. So it doesn't matter what the size of the market is. But if you're looking into a large space, then you need to be in the top three. You should have a market share which is worthwhile, and you should be, from a technology, from a business, from a client perspective, from an industry perspective, you must be in the top three of the pecking order. So unless you have a reason to become that, it is very difficult to scale up businesses. Otherwise, you'll always remain a middling little company, which may not go too far. So this is primarily the things that I have learned in my business, is that you should be one of the top three. You should have a space which is worthwhile, and you should have a motive to go and change something substantially. We all have to go and do something which changes lives of a lot of people, or it should affect a lot of people. So that's really one of the main things that we consider, is that how many people is my technology touching, and how many people is it benefiting, and how many people are transforming using my technology, and how is the industry changing using my technology. I think those are good questions to ask by any entrepreneur. And if there are positive answers to those questions, you should get to business.
That's great. I thank Mr. Raman Kumar, founder and chairman of CASHe, for sharing his valuable insights on lending industry and fintechs. Thank you, sir, for this wonderful interview. Have a great day ahead.
Thank you, Aditya. Thank you so much. Appreciate it.